On Thursday, the Bank of England voted unanimously to keep the main lending rate at a historic low, but did say it will continue to monitor inflationary pressures. Joining us now to discuss this and the impact on the pound is our senior market analyst, Fiona Cincotta. Thanks for joining us, Fiona. As I say, unanimous vote there. So we did see some movement in the pound just after it, trading around at the 139, 140 level at the moment. I think the key thing to take away was the fact they were going to continue to monitor those inflationary pressures.
Yeah, I think the meeting was a little bit disappointing for the pound bulls. I think we were sort of moving into that meeting with sort of more hawkish expectations. We do think that recent data has been really encouraging. We've had PMIs that have been strong. The economy is reopening after the COVID restrictions have been eased. We've got sort of the unemployment level has ticked lower as well. So there were a lot of points and factors were in favour of the Bank of England just adopting a slightly less cautious approach, and unfortunately that wasn't what was seen. I think a lot of the focus was also on the quantitative easing programme. We were hoping perhaps to see one or two more voters looking towards easing the QE program, and that wasn't the case. There was just the one dissenter who's been the typical hawk from the Bank of England, Andy Haldane. And so that disappointment did drag on the pound. I think what's going to be happening here, there are a lot of changes that are going to be going on to the UK economy over the next couple of months, particularly at the end of the furlough scheme at the start of autumn. And so the Bank of England are going to be cautious. They're going to be wary about how that's going to impact the UK. Also, let's not forget that at the time that the meeting was happening, we didn't really know what was going on with the Delta strain of COVID. We still, to a degree, don't. The UK seems to be on track for the final easing of restrictions on the 19th of July. But at the time of that meeting, that wasn't necessarily known. So we can see why they adopted that slightly more cautious tone, but the pound was disappointed.
They also talked about global growth, not just UK growth, and how actually that was greater than anticipated, and that then impacts on what we're seeing here in the UK.
That's right. So that is a very upbeat outlook as far as what's going on globally. We do know that over in the US, growth has been much stronger than we've necessarily been expecting. So we are seeing global growth pick up. Also in Europe, we've seen the PMIs recently coming in extremely strong, ahead of expectations, particularly in Germany. So there is that sort of backdrop, which is very much more encouraging than we were expecting. But domestically, we just need to get through these uncertainties over the next few months in order to be able to have a clearer vision of what might be happening towards the second half of the year.
I think Haldane's comments were some of the interesting ones. I think he warned the tiger is coming, and that the Bank of England needs to be ready and prepared, I suppose, with the weapons to fight that.
Yes, I mean, he's very, very, very colourful with his choice of language, and we do know that he is, he does get concerned about inflation, rising inflation. It's just that today that he expects inflation to be around 4% by the end of the year rather than 3%. So he is nervous about inflation. The thing is, he is also leaving the Bank of England. So he's no longer going to be having that sort of hawkish influence on the Bank of England, which could actually see that the policy makers adopt an even more slightly dovish tone than they have been recently. So with Andy Haldane on the way out, that's probably bad news as far as the pound is concerned.
If we then look at where the UK currently sits in terms of monetary policy and compare it to where we are seeing in other areas of the world, and I suppose ECB is the closest one to look at the moment, what can we expect there in terms of, I suppose, the gap between the monetary policies?
So as far as divergences are concerned, I think with the ECB, it's slightly less obvious than with the Federal Reserve. So in the ECB, they're very much sparring at the moment as to where to go as far as easing back on quantitative easing and bond purchases are concerned. You do have very much a division within the ECB as to what they're going to do. We've had inflation data come through. It's still hovering around that 2% level, which is their target level. You have part of the ECB camp thinking that the inflation is transitory and therefore it will be easing back. And then you've got
I think just like you've got Haldane, you've got Dividman. I think what was his quote about the Galapagos tortoise, which they thought was extinct for 100 years and turned out not to be. And he said the same for inflation. So you've also got, that in that camp as well.
Completely. So it's that very much that division going on, and they're sparring between where to go next with that. So we're not seeing any movement right now. It's going to be in focus, the rhetoric surrounding reining in sort of monetary policy going forward. And then you've got the Fed, who are very much on a very different level to the rest of us, to the Bank of England and to the ECB right now. They're very much looking towards sort of what those next steps are going to be. You've got the market getting a little bit nervous. Inflation is high, and the Fed are starting to give mixed messages now. So before, they were very much sat on the side that the inflation rise and spike in inflation is transitory and we will move through it and we're in no rush to raise interest rates. Now we're seeing a more mixed sort of rhetoric surrounding it. You've got Fed Powell, who's still very sort of comforting and soothing to the markets, but then you've got other policymakers who are much more hawkish and expecting to move perhaps sooner. So we're seeing that come through in the value of the dollar. The dollar's been on the run. I mean, it's been up for the straight past 6 sessions. It's trading up around sort of 2.5-month highs. So we are seeing that come through now in the strength of the dollar. And also, as far as the broader markets are concerned, we've got stock markets in the US trading at all-time highs. But when we get rhetoric surrounding sort of possible hawkish moves, then we start to see those indices move off those top levels.
When we're looking at the currency market, bearing in mind what we talked about, different monetary policies, which is the currency pair you think that we should be watching in light of that at the moment?
I think where we could see the biggest diversion is between the euro and the US dollar. I think that's where we've got potential to see the biggest difference in what will be happening. So with the Fed looking to move forward at a quicker rate than we expect the ECB to move. I mean, the ECB and the Eurozone traditionally has a very bad history with inflation. It suffers from low inflation. It seems to have suffered from low inflation for as long as I've been involved in the markets. And if that is the case, then we could see that sort of really having a weakening effect on the euro-US dollar.
Okay, thank you very much. Fiona Cincotta there, our senior market analyst, talking tigers and tortoises, but overall looking at what the outlook is for economic policy, monetary policy around the globe.